Hey, what's up, guys? Today I'm going to talk a little bit more about market structure and how I use it to trade. Do you need market structure to trade? No, but I do think it's a good framework and a good tool to use to ensure that you're on the right side of the market. So, the purpose of market structure is to build a framework to map out and add structure to a blank chart for more successful trades. We don't want to be this guy in the gift, so let's take a look because I know we were all this type of dude or woman when we first started out trading. You see price just going up, 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 and then you go long and then it goes right against you. So market structure definitely helps with not buying the top and more so buying the bottom. So what we're going to talk about today is why is market structure important, the components of market structure, how to map out the structure and some guidelines. Just remember, trading is very subjective. There's many ways to do things. This is just my way and how I like to do it and what works for me. And you can cater this however you'd like. And then some trading suggestions, common mistakes, and then we'll dig into the charts and do some chart analysis. So the why. So market structure will help you with biases. So when the internal structure and which is essentially the price action and order flow on a chart that you're looking at intraday aligns with the external structure, which is the larger trend, right? The overall big picture. It provides traders with a more robust and reliable trading signal. The convergence of these biases suggests that various factors are supporting the same directional move, increasing the likelihood of a successful trade. And then also helps with identifying a trend and maybe a reversal point. So market structure helps traders identify trends and potential reversal points. By analyzing price patterns, highs, lows, key support, resistant levels, traders can gain insight into the prevailing market sentiment. Recognizing trend direction and potential reversal zones enhances the probability of making a profitable trade. And then risk management. This is personally my favorite when it comes to market structure because I love risk management. So following market structure is integral to effective risk management. Traders can use key levels and structural elements to set stop losses and to define risk to reward ratios while determining the size of your position. Understanding market structure helps traders avoid placing trades in areas with higher uncertainty and potential for adverse price movements like you saw on that GIF. And contextual analysis. So market structure provides context for price movements. Traders can interpret market behavior within the broader context of the prevailing trend, identifying whether a price moves in a retracement within a trend or a potential reversal. Contextual analysis is crucial for making well-informed decisions and avoiding impulsive trades, reducing noise and false signals. So following market structure helps traders filter out noise and false signals. By focusing on key structural levels and patterns, traders can avoid reacting to short-term market fluctuations that may not be indicative of a significant trend change. This reduces the likelihood of entering trades based on misleading information. We saw this on, I think it was Thursday on NQ when we had a pretty good pullback, but we were pulling right back into a demand zone and people started to short near the bottom right as price reversed. So we'll take a look at that a little later on as well. And adapting to changing market conditions. Markets are dynamic and evolve over time. And that's one thing we need to realize. So when you map out market structure and it's a bullish market structure, when you have a sell-off or a pullback inside of that, you know that it's just the dynamic range of the market. You're going to have highs, you're going to have lows, you're going to have pullbacks, right? You understand that. So understanding market structure allows traders to adapt their strategies to changing conditions. So like I said earlier, you don't need only market structure as a strategy. You can use it as your sole strategy, but if you combine it to whatever strategy you're currently using, it's just going to help you out in the future. And then whether the market is in a trending or ranging phase, traders can adjust their approaches based on the prevailing structure. And confidence. I could tell you my confidence skyrocketed in my trades. So once I've started using market structure and I know I've entered in a logical area and my stop loss is in a logical area, I'm not really nervous anymore about my trades. I know that my trades work out more times than not. So when I do take a loser, I know that the probability of my next trade will most likely be a winner. So trading with an awareness of market structure provides traders with a logical framework for decision making. When the internal and external biases align, traders can have greater confidence in their analysis, making it easier to stick to their trading plan and avoid emotional reactions to short-term market fluctuations. And now we can get into the components of market structure. So we have external structures and internal structures, and we'll break those down one by one. So what I consider the external structure is basically the bigger picture, right? So this can come from the weekly, daily, 4-hour. I primarily use, I look at all those actually, but I primarily use the 4-hour levels and structure to base my trading off of. And then, so inside of external structure, you have your swing highs and your swing lows. You have a break of structure, which can consist of it either being a trend continuation or a reversal break of structure. And what I mean by that is you have this low down here that created this high. And so when we see that, we have our external swing low and our external swing high up here. And price can do whatever it wants in between that range that the external structure just created. And it's important to know that. And then once we have a pullback and price pulls back and forms a higher low, and then the prior higher high gets taken out. And then this is very important to understand this note down here. In a bullish structure, the external low comes from the lowest low after the highest high initiated a pullback, and vice versa for a bearish structure. So what do I mean by that? So this red line, right, is the internal structure, and we'll get into that in a little bit. But it's basically just the price action that's happening, right? And so when you're looking at a higher time frame, you can identify the swings a little easier because there's no noise. And so when you map out your swing low down here and your swing high, and price starts to pull back, because remember, price is dynamic, and then we get price to break the higher high, which is then a break of structure to the upside, which is basically just a trend continuation. Then you pick the lowest low after the pullback started and then use that as your new, this low will be your new external low. And then you must wait for price to continue trending up and then start to have a pullback. And when it has a pullback, you've then created a new external high. So then your range consists of this. And essentially what market structure is all about is waiting for price to come back in a reasonable area near the external low in a bullish context, and then buy with targeting the external high. And then another signal we can use to buy and to see when price is sort of done pulling back on an intraday time frame, we have internal structure. So the internal structure is the red line, basically. And forgive my drawing, it looks terrible, right? It doesn't even look like the market, but it has highs and lows and it makes sense. So what I consider the internal structure is the price action. It's the order flow. It's what we trade off of. And it's important because when internal structure, for an example, is trading near the external high, you don't want to long and you don't want to short. You don't want to long because you're near the highs, and you don't want to short because we're in a bullish context. So I really love market structure because it maps out and adds a framework to your chart and kind of, it stops you from making bad decisions. So we have our internal swing high and low. So the same as we do on the external structure, we have highs and lows, highs and lows. And these are trading ranges as well. So once you can start to see this on a chart, in which I'll bring up charts and we'll analyze them and we'll come up with some examples and whatnot so you can better see it. So external structure and internal structure follow the same rules, except you can name it however you want, but the external structure has a break of structure. Whenever we break to the high side, that's a break of structure. It's a good sign in a bullish context. And then on internal structure, you have what they call a change of character. I call it a break of structure, but you can, if you want to differentiate the two, you can. It's either a change of character or an internal break of structure. But all that means is that when your internal structure, which is somewhere around the 15-minute, 5-minute, or 1 minute, starts to make higher or lower highs and lower lows, then price has entered a pullback, and you don't necessarily want to short that, right? You want to wait and see price pull back to an area of demand or support so you can long, because in a bullish context, you don't know when or where that price might find some type of support or demand and continue higher and then hit your stop loss. So you always want to trade with the trend. And essentially what a change of character is, right? We have two types, just like we have two types of break of structures. We have either a trend continuation where the break of structure breaks out, continues and follows the trend, or we have a reversal break of structure where price ends up trading down and breaks the low, your external low. So once you map out your external high and low, and you now have a range in a bullish context, if price comes down here and breaks your low and continues to trade below it, that means you have a reversal break of structure, and then now you can start looking for shorts. Now on the internal structure, when you have a break of structure or a change of character, it just signifies that price has now entered a pullback, right? And then now, once price has entered a pullback, you're going to wait for it to change character again, right? You formed a high right here and you have a low right here. We broke the low and then we broke this high at creating a higher high within the internal structure. Now that the internal structure is aligned with your external structure, then you wait for a pullback on the internal structure, right? And then enter long. So now, this simple principle helps keep your risk to reward very tolerable, because your stop loss would go below your external swing low, which in theory is a protected low, right? And your external swing highs are weak highs because you expect them to get taken out. You don't expect your swing low to get taken out. Now, it does happen. The market is dynamic, right? We're going to have trend changes. But for the most part, when you look at a chart, when we're trending or moving up or down, those last longer than they do. They last longer than they don't, right? So most of the time, you're going to stay on the right side of the market when you follow market structure and add it to your trading strategy. And so as you can see here, we have a higher low, a higher high, and then we had a pullback, and this low right here broke this high. So now we have a higher low and then form another higher high, and then price is retracing, and then we break our protected low on the internal structure side. So now we have a change of character. We've now mapped out our external structure high up here, and then now we know price is in a pullback, and we expect it to not take out this low right here because we marked this high. Price has now entered a pullback, and now we're looking for buying opportunities. So say for an example, we had a demand area down here. Price trades within it, and then you see we formed a lower high and a lower low, and then price breaks that lower high, and then now we have a change of character to the upside. So our internal structure now aligns with the external structure, and we can start looking for longs. All right, so let's get rid of all this and let's continue. Hopefully that made some sense. And so here's more of an example, and we'll kind of go over it from the start. So we have price starting over here at the far left, and let me pull up a little highlighted cursor so you can better see it. All right, there it is. So we have price coming down, right? We'll just call this our high for an example, right? Price pulled back. We broke above this high. So now we have an external low, and now we're waiting for price to put in a pullback before we determine what the external high is. And then once price has entered a pullback and we've mapped our external low and our external high on, for an example, a 4-hour chart, then we can start taking a look at, for an example, our 5-minute chart, which I personally love to trade on when I'm trading market structure. And then I start to see that price is in a pullback, making lower highs and lower lows. And all I simply do is I start marking out things on the chart that look like where price could either find support, demand, or somewhere, right? And then when I mark that out and price comes to the key zone or key level that I marked out, and then we have a change of character, and now our internal structure aligns with our external structure. I look for long opportunities, and when you're trading market structure and you enter long, and every structure you're looking at, external and internal, are bullish after you've entered a pullback, then you can either target the highs up here, right here, or if you're more conservative, you can target the swings that the pullback had, right? And then so we continue going, right? Prices, we continue making external highs and lows, and our internal structure keeps changing. And then what happens when we have an external low and an external high, right? And then remember, price can do whatever it wants in this range, and that's very important to understand. We can have aggressive sell-offs, right? And it may look like the market's about to just tank, and then we end up finding demand down here at the lows and take it higher. But then what happens if you have a break of structure to the downside? Well, some people would like to see a break of structure to the downside, and then some people would like to see price make a lower high and then another lower low, forming another break of structure to confirm the downtrend. I don't really trade that way. I wait for that first break of structure, wait for a pullback, and then I go short targeting the lows because I like to take that chance. And then if I get faked out, then I just go back and review and see why I got faked out. But another key thing to note here is when we have a break of structure, right? It's not this low. It's not this lower high it's not this lower high that made this low. It is this old higher high that made this low down here. And why is that? Well, you want to use the point at where price originated from that changed structure, right? Something happened up here to change the market sentiment to now want to take out this external low. So now this becomes your external high in a bullish in a bearish context. And then price broke this external low down here. So now we have a break of structure, which is a reversal to the downside. And as you can see on the chart, I kind of color coded bullish structures and then bear structures with red. I kind of do that too on my internal charts, not my internal charts, on my like actual trading charts. Or sometimes I just keep them just a neutral color, and then I know what I'm looking at. But when we make this external low, now our trading range is this huge range. And then the same principles apply from this big range. You just wait for either price to break the high or break the low. But now you have the context of, okay, we're now in a bearish structure. So you want to look for shorts, right? And then price finds a lower high and then ends up breaking structure again. And then you just repeat the process. So let's talk about some rules or guidelines I like to use when mapping out market structure. So when constructing any structure or framework, it's crucial to adhere to a systematic approach. This ensures that each time a new structure is created, the overall framework remains consistent and uniform. And then one of those things that need to stay persistent is pullbacks. So which is basically the initiator for any swing high or low. So for price to make a pullback, the highest candle in a bullish trend has price wick and close below the body of the highest candle, and the lowest candle in a bearish trend has price wick and close above the body of the lowest candle. So I have 4 figures total. There's 3 on this screen right here. So in figure 1, you see obviously we're in a bullish context and bullish structure, and we form a high right here. And then this high's low is all the way down here. So when you see price start to pull back right here, some traders might think this is a pullback, but that's not actually the case because these are just inside bars to this large bullish bar. No pullback has been initiated yet. You want to see the low of this candles get taken out, which that happens on the 19th bar. And that's important to realize too. And here on figure 2, this is still right. You have a swing down, and then you have a green bar. This is also not a pullback because it's inside of this large bearish bar. And then we have price continue, even though this ticked above, right? And then we have another large sell-off. And then now we put in a new low, and then the high of this low's candle gets taken out, and that's considered a pullback. And then here we have some interesting ones too. So we have a sell-off, and we have this large bearish candle. and I kind of have them color coded. All these candles, 1, 2, 3, 4, 5, are just inside bars to this large bearish candle until we end up making a new low. And now we made a new low, and then the high of the lowest candle still doesn't get taken out. We have another inside bar, and then we make another low. So now this low has price take out the high, right, of this lowest candle, and now we formed a pullback, which is also now considered your external or internal swing low. You want to use the lowest, and you want to use the most extreme candle or where price is gone to mark out your external lows, highs, and your internal swings as well. And then so here's another pullback, and we saw this on ES, right? This is ES this week, actually, I think last week, right? We put in a double top. Price is 47.81.25. So when you have a large candle like this, which marks the high, and then you have two inside bars, which clearly had a pullback, this signifies as a pullback because these are two equal highs, right? So this candle right here can be considered the high, and then we had a pullback. So, but like I said, the market is very subjective. So if you want, you can consider this an inside bar and then consider this the high. But me personally, I view this as a pullback. And then, so here are some more rules and guidelines. So what happens after, so let's talk about the break of structure. So wicking above a swing high in a bullish structure with the body closing below the swing high, meaning right here, right? We have a swing high, we have price pull back, and then we have price wick above it. All right, that's what I'm referring to when I'm saying the body closing below the swing high is just a liquidity sweep, not a change in structure. That high has not been broken until a candle's body closes above, which will then form the new high. So right here, we have a high, price pulled back, which is sort of like a two-legged pullback, it looks like, when we formed a swing low. And then this low down here, because it is the lowest low after this high made a pullback before breaking the structure. You see this candle right here closed above this high. So now we have a break of structure to the upside. And then we wait for the highest candle to have a pullback before marking our swing high. So now we have a swing high right here because this candle broke the low of this highest candle. And real quick, a liquidity sweep in the context of price action just refers to a situation where the price briefly drops below or above, in this scenario, a previously established bullish swing low or bearish swing high before resuming its upward or downward trend and reaching new highs or lows. So what this just means is, and we can't get away from this, right? So we see this two times on this chart. So we see these highs, the liquidity got swept, we have a rejection, and then price continues its upward trend. And then we had a pullback, right? And this is our swing low down here because this low created this high. And so how can we, so now this becomes our structure, and price can do whatever it wants on the inside of a structure, right? Inside of the structure range. And then we have another liquidity sweep before price reverses and then makes a new high. So you can sort of see this is probably like a range, which it does look like price is congested, but no matter what, market structure still works and it plays a factor in ranges, and it still keeps you on the right side of the market. And I have down here, a way to protect yourself from liquidity sweeps is to wait for that lower time frame internal structure to align with the external structure before entering your bias. So you want to wait for that internal structure on a lower time frame to switch bullish, and then you enter and put your stop loss below the swing low. And the same thing is right here for a bear. So wicking below a swing low in a bearish structure with the body closing above the swing low is just a liquidity sweep, not a change in structure. That low has not been broken until a candle's body closes below, which will then form the new low. And post break of structure. So you have price break structure. Now what? Now is not the time to go long, right? So you expect price to now retrace to a key level or zone, whether it be supply or demand, support, resistance, or fair value gap. I can make a video on those later. You expect price to pull back after it breaks structure because the market is dynamic. So price is dynamic and inevitably swings. Seeing a sell-off or a pullback inside of a bullish structure needs to be seen as a buying opportunity and vice versa. Buy low, sell high, right? So I was kind of talking about this earlier. You see, we had a break. So we created a high right here. Price pulled back. So we had a pullback. So this is our new high. And then this became our new low because this low created this high up here. And so now we have our structure, which is still intact, and we're still trading in this range as of today. This is the 4-hour chart on NQ. And so what we saw was after price pulled back, we had an aggressive sell-off. And I remember seeing in the Discord I was a part of, people start to enter short down here. I'm thinking we're going to continue to sell off. But then they weren't aware of that the structure is bullish, right? And price is just retracing to some form of demand or support before continuing higher. So trading market structure. So what are some tips or tricks with trading market structure? So me personally, I like to give myself the best risk to reward. So in a bullish structure, wait for price to pull back 50 to 70% toward the external structure swing low, and then wait for the internal structure to have a trend alignment, a break of structure before entering long with a stop loss below the external swing low. The deeper the pullback, the better risk to reward you have. So let me just go back on the chart real quick. As you can see, we formed a high before creating a pullback. Price aggressively sold off, but where did price close at? Price closed right at the 70% pullback. It bounced off of the demand zone and in this area of congestion right here. Right? Price came back, retested it, and then we came up and retested the highs. That's a perfect example of market structure retracing back to an old support level or demand zone. And then same thing in a bear structure, wait for price to pull back 50 to 70% toward the external structure swing high, then wait for the internal structure to have a trend alignment, change of character, or break of structure. You can use either one of those names before entering short with a stop loss above the external swing high. The deeper the pullback, the better risk to reward you have. So let me back up one more time. And the reason I'm using the 50 to 70% retracement rule is because no matter what, if you decide to enter anywhere below the 50% and above the 70%, or even lower if you want, if you enter around here and then you put your stop loss below the swing low and you target the highs, the difference between here and here is greater than a 1-to-1 risk to reward. So no matter what, if you wait for price action to pull back deep enough near a significant level and then you enter long targeting the highs, then you have good risk to reward. So that's why I like that guideline and that's why I use it. And then, and also only enter near key levels. So near supply and demand, support and resistance, a fair value gap, and then don't fiddle in the middle of a range. And so I say you can buy the 50% area, right? But let's go back. And if price comes down, right, and you have like a automatic buy limit right at the 50%, you're kind of fiddling around, right? You don't know for sure if price is going to bounce here. You kind of want to wait for price action to tell you what it's going to do. And while your risk to reward would be a 1-to-1, it's not really the smartest thing. So that's why I like this 50 to 70% area right here, because you'll notice if you go back and back test this and just look at the chart and try to practice market structure, price loves to pull back within this range. And then if you draw trend lines on a chart, that's essentially what you're seeing is price retracing 50 to 70% within a structure, and that forms the trend line. So here, this is the lower time frame chart from slide 7, where price pulled back 70% into a demand zone. So let's go back to slide 7. I added more slides after this, so I'm messed up here. I'll fix that after the video, but I guess it's a little too late now. But as you can see, price pulled back to a demand zone, right? We switched to a lower time frame. You can see price is selling off, right? Doesn't really have a change of character or break of structure yet, but you can see down here we made a low, and this low had a pullback. And then this high, right, this lower high made this lower low down here. And then what do we see? We see this lower high, which is your internal swing high at the moment, get broken. So now we have a break of structure to the upside, right? And so now the internal structure is aligned with the external structure, and it happened at a key level. And as you can see here, that happened right around here, and then price went all the way up and retested the highs. So that's the point of market structure, is being able to identify sort of like when the reversals happen, when your external structure and internal structure are aligned to give yourself a higher probability of winning trades. And so let's talk about where logical stop losses can go. So can you put your stop loss above and below an internal swing high or low after you have a trend alignment break of structure? Yes, you can, but you have to accept the fact that price can continue to trace back further inside of the external structure, potentially taking out your stop loss. And that's exactly what we see in this example right here. So we had price make a high right here, and then we pulled back. So now we have an external swing low, and then price broke structure right here because it took out this high. And then we made a high right here before price started to pull back. And you could say that price pulled back 50 to 70%, put in a beautiful rejection wick, right? Or a demand wick. And then say you entered right above this hammer candle, and then you put your stop loss below the low inside of the internal structure. Well, what happens? Price barely goes into profit, comes back and takes out your stop loss. Why does it do this? I don't know. Maybe a lot of people did. Maybe a lot of people entered here, and then there was a lot of stop losses here, and so price came back to grab liquidity, and then we went higher to take out the highs. Who knows? But if you follow the simple rule of entering in the 50 to 70% range near a key level, so say for an example, you waited for price to pull back in this demand area and then put your stop loss below the external swing low, you can see that the external swing low was protected the entire time, and then price continued to go higher. So that's just an important thing to kind of realize and to understand when you're trading inside of a external structure, that price can do whatever it wants on the inside. But the basic principle is that in a bullish scenario, the external low is protected and will not get taken out. And then same thing in a bearish scenario, you expect the swing high to be protected and not get taken out. You expect that the lows keep making lower lows, right? And so what are some common mistakes? Let me remove that. So what are some common mistakes when it comes to market structure? So some common areas or some common errors in trading with market structure include misidentifying the external structure and confusing an internal break of structure with an external structure break. So another prevalent mistake is placing the stop loss in an illogical area and lacking patience. Rectifying these common errors can elevate your trading proficiency and make you a more effective trader. So that last slide is sort of what we were talking about with the illogical stop loss. So with the understanding now that price can do whatever it wants in an external range, now you want to enter at the best possible area and put your stop loss below the external swing low. And then right here, this is Friday's NQ chart. And I saw somebody enter long in right here, and they said that the internal structure or the structure has shifted bullish. And I was like, wait a minute. No, it didn't. And you can see, unfortunately, it did not. And we had an aggressive sell-off right after it grabbed liquidity above this swing high. So, and then you can see if you just waited for this internal structure to break to the downside, it would have worked out for you and you would have never entered, right, at the wrong area. So what we see here is we have an external swing high. Price came all the way down, right? And we made a low right here, but there is no pullback yet. And then we made a new low, and then this low had a pullback, and then we had a sell-off, right? And this low never had a pullback either. These are all inside bars, 1, 2, 3, 4, until this low is made and this low is made. When this low is made, we then have a pullback. So now our external swing low has been identified. So now our range is this area right here. So price can, like I said multiple times already, I don't want to, I guess, keep saying it and keep saying the same thing over and over, beating a dead horse, but I guess sometimes you have to, is that price can do whatever it wants in this range. And you want to wait for the internal structure to shift back to bearish. So we did have an internal break of structure to the upside, right? But it's not smart to go long because the context is bearish. So this trader saw price make a higher low right here and enter long right above here, in which he was profitable, right? But it just wasn't the smart trade to take because he thought we now like found a bottom and we were going to go back up to the highs. So what happened is you have a bearish structure to the downside, right? We're making lower lows and lower highs. And now you wait for price to come back and retest some area of supply or demand. So you have this area of congestion right here. So I'd mark that up, and that's essentially what we did. I'd wait for price to get here, and then I'd wait to see what happens. And then we get a sell off and then take out the lows. All right, so some chart analysis and live trade example. So we can go ahead and go over to TradingView and take a look at ES, where I took a fantastic short on ES on Friday. And unfortunately, the trade took 3 hours, but I'll add the sped up clip at the end of this video. But real quick, I can take off this cursor. We have a blank ES chart right here. And what we're going to do is I'm just going to map it out with you. We're on the 4-hour chart. We'll map it out, see what I saw, and then we'll go down to the 15-minute and 5-minute because those two gave me the extra confluence that I needed to take a short position. And somebody in Discord was like, why are you shorting a bullish market right now? And I was like, well, the market structure is bearish on the 4-hour, the 1-hour, the 15-minute, and the 5-minute. Even the 1-minute switched bearish. So I had to give it a shot, right? I have to back up what I preach. So let's take a look. So what do we have? Obviously, we're in an uptrend. We see that. And so let's just start mapping things out. And a quick way to do this is you can just find the latest high that got broken and then work from there. So we can sort of just start from right here so you can see how I map it out as we go. So we have this high, right, that got broken. So this is a break of structure to the upside. And where is the low that it made? So you find the lowest low after the high was formed. So this is our low. So this is a 4-hour swing low. And then how high did price go before entering a pullback? So price was right here before entering a pullback. So that became our swing high. And obviously this seemed to be some like news event or something, but this was the highest high before we had a pullback, right? So now this was our structure to trade in, right? And let's just, for giggles, let's see where price retraced to, because I'm not a Fibonacci trader, but I bring up the Fibonacci tool and I specifically look at the 50 to 70% range. And I like to just be situationally aware of how far price has pulled back. And if I can join that up with price in like some congested area in some demand zone, and price comes back and taps it and I see some demand step in and we're below the 50%, then why not give the trade a shot, right? Because your risk to reward is already greater than a 1-to-1 when you enter below the range is 50%. So let's continue mapping this out and we can see that price pulled right back to 70% before making a new high. So now we have another break of structure and a new high. So our next high is, so we created this high, but we have two inside bars until we make this high right here. So this became our high, and then our break of structure was right here. And then now the lowest low after our old high is right here. So now this is our range. And as you can see, it looks like price came back and tapped this this high right here before going higher, but that's irrelevant. One of the key concepts is to market structure is you really never would have entered long here unless the lower time frame signified some structure shift to the upside and you use like an intraday strategy. But price, I think, didn't even, let's see if price came back to the 32 per, like no, price stayed above. So if you entered in long right here, I mean, just look how terrible your risk to reward is, because with the context of us knowing that price, and say if you want to go target the highs, right? We know that price can do whatever it wants inside of the range, right? And you enter up here, that's a terrible risk to reward. And so when you see that, just wait for an opportunity to set up. Opportunities are everywhere in the market, right? You have to be patient. And so now we just continue marking this out. So now our break of structure is right here because our swing low, we made a swing low right here. And then price broke this high. So now the break of structure is right here. And then we created this high right up here before entering a pullback. And this kind of happened a little quick, right? And it's like a tight structure. So we have our swing high, we have a pullback. And then so we've created a new swing low because this swing low right here took out this high. And so now we have this high and price broke the prior high right here. So we have a break of structure to the upside. So we're still bullish. And then very quickly, we shifted structure to the downside. Why is that? Because we expect this swing low to be protected. Well, it wasn't. It got taken out. So now this becomes our swing low down here. And then this is still our swing high, right? Because this is the highest high that created this low. And now the break of structure moves down to right here. And so on Friday, this was our range, right? This whole area was our trading range. So I knew we had a bearish structure, so I was looking for shorts. So then I went down to the 15-minute chart, and then I started mapping out and looking at the 15-minute. And what do we see on the 15-minute? Well, like I said, you can just start at prior lows and highs. So you can see that this high right here, well, let's just start from over here. So this low made this high, and then we have price breaking this low right here. So on the 15-minute, the 15-minute is bearish as well. And I marked this high, and as you can see, this high had a liquidity sweep and price could not get above it. So that was just some more context for me to look for shorts, right? And we still have this low down here. So everything was showing bearish to me. The price couldn't make a new high. We broke structure to the downside. Price pulled back, couldn't close above the 15-minute swing. And then, so I went down to the 5-minute chart, and let's take a look at Friday. So this is Friday right here. And like I said, I'll play the live trade, but I started mapping out the 5-minute structure as well. So what I saw was that we had these group of higher lows and higher highs over here. So I just found like the latest one, and I saw that price broke structure to the downside. So we can just kind of use this structure over here, and then we can use this high up here. So what happened? We obviously broke all these higher lows to the downside. So now this high created this low down here. And if you want, we can just add some names to it. So an M5 swing low, and we have a swing high up here. All right. And where did it break structure? So we broke structure right here, because this low, we had this high, we had a pullback, and it made this high. So now we had a break of structure to the downside. All right. So we have this high and we have this low. Now price pulled back into this group, this congested area right here, and then made a new low because price closed below this low. So now this becomes our swing high. Our break of structure is down here now, and this becomes our low. And then once you get better at mapping this out, you can just kind of look at it and just start to tell, right? And this is where I entered short. So I entered 2 contracts, one, and then I pulled out the Fibonacci tool, and then I was like, okay, where's price going to pull back to? So I entered one short around the 70. Once I saw price having these rejection wicks at the 70%, I entered one short right here, and we can change this red. And then I started mapping out, well, this is a demand or a supply zone right here, because you have the origin of price before it had an aggressive move down. So I like to use the candle before the up move candle in supply situations before an aggressive move down, and I like to mark that area as supply. And as you can see, it respected it really well. But I entered one contract here going short. It went in my favor, but I was wanting to target the lows. And then we had price start to retrace back up, and then I entered another short right here. And so I was in for 2 contracts, and I had my stop loss right above the M5 swing high. So I entered, we can say the average was right around here, and my stop loss was at 80.25. And then I was targeting the lows, and then we can move that over. And so why did I take the trade? Well, because the 4-hour broke structure to the downside, the 15-minute was bearish, and also the 5-minute was bearish. Right. And so I figured that now that we broke structure on the higher time frame and the lower time frame is aligned, maybe today is a pullback day in the market, when in reality, all we kind of did was trade sideways. But you can see how, if following market structure rules, I stayed on the right side of the market, and I eventually got my profit target. I actually targeted the candle lows right here and not the wick, because this was already 3 hours in, and I needed to get my day started. And I'll be honest, right? I was getting anxious. So I kept moving my profit target up just slightly, but it was still greater than a 1 to 2 risk to reward. And I got at 64.50 right there. But that was my trade. And now I hope this kind of maps out market structure a little clear. If it doesn't, please let me know. And then I can try to dig a little deeper. Or if you have any questions, feel free to message me or leave a comment. Please subscribe, share. But I would love some criticism on if you learned anything more about market structure and how to use it in your trading strategy. But I'll go ahead and play the live trade so you can see it. It's going to be sped up, I think, like 10,000% or 1,000%, something like that, because it was a 3-hour long video. But stay blessed, happy trading, and good luck this week.